At MTN, our ambition 2025 is to provide leading digital solutions for Africa's progress. In 2022, just as we all started to emerge from COVID-19, the world suddenly faced challenges of a different kind, and the impact of these rippled through our markets. But as we did during the pandemic, we, in partnership with our stakeholders, made a plan. We rolled up our sleeves. We asked our stakeholders how we could help. We engaged more. We partnered more. We contributed. We connected more people. We provided the best customer experience, leveraging the most valuable African brand. We contributed to reducing the cost to communicate. We delivered results to our shareholders. We remained inspired by our belief that everyone deserves the benefits of a modern, connected life. At the heart of it all, one singular question continued to drive us. What are we doing today? We are building the largest and most valuable platforms. We are driving industry-leading connectivity operations to accelerate our vision of providing leading digital solutions to support Africa's progress. We are creating shared value. We are living inspired thanks to our 17,000 skilled and dedicated MTNers. We are creating the MTN of tomorrow. We know headwinds remain, but we are up for it. We are doing for tomorrow, today.
Good afternoon, everybody, and welcome to MTN Group's annual results for the year ended the 31st of December 2022. I trust you're all well. I'm happy to be joined by our investors, analysts, and other stakeholders at the Innovation Center. My name is Tato Motlante, and I'm the Head of Investor Relations. We're also a warm welcome to the MTNers across the markets and everyone who's dialed in throughout various platforms who are either watching on CNBC Africa, the MTN YouTube channel, or on the webcast that we've provided. Let's first get through some of the housekeeping before we start. And on the screen, you should see our standard disclaimer and safe harbor statement, and that covers our presentation for the day. And for those in the room, just a quick reminder of the emergency exits. There's one exit on my right and one at the back of the auditorium. Turning to the period under review, and just to set some context, I think the past 12 months has been pretty difficult. It's brought challenges that have continued for many companies around the globe, and that includes MTN. Our business has, however, demonstrated true resilience, and as we've continued to roll up our sleeves in fairly rapidly responding to these challenges and taking the lead in the ever-evolving landscape we find ourselves in. We're driven by the belief that everybody deserves the benefits of a modern connected life. The presentation today will reflect on the full year's strategic, operational, and financial performance, and I think just in terms of the agenda, the program will run as follows. MTN Group President and CEO, Ralph Mupita, will give us a strategic and operational overview. He'll be followed up by Tsulu Molefe, who's our Group CFO, and she'll provide financial highlights. Thereafter, Ralph will come back onto the stage to give us a sense of the key focus areas for the coming year. We will then open up the floor for questions, and Ralph and Tsulu will come up and answer these. And for just for those who have dialed into the webcast, you can use the platform to send through your questions. For those who will be tweeting during the session, the hashtag is MTN Annuals 22, and our Twitter handle is @MTN Group. And it's now my pleasure, as the crowd goes wild, to welcome on stage Ralph Mupita, our Group CEO.
I'm not sure about the crowd going wild there, Tato, but a very good afternoon to everybody joining us for this results presentation. And to all our investors and our stakeholders who've joined us at 14th Avenue, it does feel a little bit like the pre-COVID situation where we had this room full to the rafters, and we appreciate those who've made the efforts and those who've joined us on other platforms. Also a special thank you to all the MTNers who have been delivering the results that Tsulu and I have the pleasure and privilege to present. Thank you. I mean, this is we're presenting on behalf of all of you. You should have now had some time to look at our very comprehensive SENS announcement released earlier on that has got quite comprehensive feedback around what we did last year in terms of operational, financial and strategic progress. But what Sulu and I will attempt to do in the next hour or so is to give you some of the salient features within the results, as well as to focus a little bit on the year ahead and what the key areas that we see as MTN management. But before I go into the strategic and operational review, let me start off by picking up a couple of highlights around how we saw the results. We saw 4 key messages coming out of the results, which I'll try and summarize. The first is we saw very strong commercial performance in a very challenging macro. We're able to grow our subscriber base. We're now at 289 million subscribers across our 19 markets, and we're particularly encouraged by the progress around the demand for data and fintech services, which I'll talk to in a little bit more detail. We continue to see strong data net additions coming through our business, as well as the fintech subscribers and the fintech ecosystem continuing to expand. That'll be the first message that I would want to highlight. The second is that the company is in stellar financial health. We haven't had the leverage as low as it is now, so the holdco leverage at 0.8 times, consolidated leverage at 0.3 times, and we have cash and undrawn facilities collectively at 60 billion rand, which gives us the ability to be able to withstand any shocks that may come through in the year that lies ahead, but also an ability for us to take advantage of opportunities. These challenging times often present opportunities, and we need to be well arranged and have the financial resource to be able to take advantage of them. So we're very encouraged by the resilience that is within our balance sheet. The third message is we are making progress in Ambition 2025 and executing aligned to what we have promised stakeholders. Good to see progress really around fintech and fiber cost separations. Fintech is the one that we've been focusing on the last couple of reporting periods, and we're glad that we can report that we are making substantial progress in the structural separations of these businesses. It's heavy lifting market by market to create the group fintech structure, and we've made very pleasing progress. And as we announced with our results, we've also received offers for minority investment from potential strategic partners that we are busy reviewing, and have given ourselves a timeline of 6 to 8 weeks to be able to come back and conclude on that process. So we're very encouraged by the engagements that we've had so far. The other point around strategic progress is really around our asset realization program. We set out a target of 25 billion rand of monetizations over a 3-year period. So we're reporting that we've done 18.8 billion, and 12 billion of those proceeds actually came through last year, which was actually a very challenging year, but we managed to get upstreaming and cash out of markets such as Nigeria. And the final point I'd raise on the strategic progress is really around the progress we've made towards exiting the consolidated Middle East markets. We're out of Syria and Yemen, and we've done a lot of work towards getting out of Afghanistan, and we've signed the SPA with M1, and now it's subject to regulatory approvals as well as transition agreements. In terms of creating shared value, again, good progress. In the year under review, we actually increased our capital expenditure investment into our networks and platforms by 17% to just under 38 billion rand. But at the same time, we brought the cost to communicate down by just 22.7%. We increasing broadband coverage across our markets, and we're making a very healthy contribution to capital formation of countries that we operate in, as well as paying the taxes that are due from the economic activity that we make. So those would be the 4 headlines that I would raise right up front. This chart that you see is one that we've shared since the end of COVID. During COVID, there was quite a demand shift as people moved online and moved to the homes, where we saw very strong growth, both in terms of data and fintech services. We've continued to track this graph, which basically looks at how much additional demand have we seen in our networks, particularly for data, on a quarterly basis. as well as the transaction volume on fintech platforms. So you can see during the start of COVID to the end of lockdown arrangements, on the data side, we're seeing 570 petabytes per quarter, and post that, it's moved to 939. And on the fintech transaction volumes, we were seeing more like 1.9 billion transactions. Now we see 2.9 billion transactions, since the quarter. And if you look at the graph at fintech, actually in the year under review, you saw a very strong surge in the level of transaction activity. And as I'll explain later, we've seen a very healthy development within the merchant ecosystem, which is really driving the activity. So the key message with this slide is that we still see continued structural higher demand for data and fintech services across our markets, and that's fueling the growth that you see in the non-financial numbers as well as the financial numbers. Just talking about the highlights from a non-financial perspective and sticking with data and fintech services, you can see we've had very healthy growth on active data users. Now we're at 137. Our 2025 target is to get to 200 million. So we feel that we're making good traction there. And then on mobile money, we grew by 21%, up to 69 million. Again, we feel highly convicted that the progress we're making is taking us towards the 2025 ambition that we set out of 100 million mobile money users by the end of 2025. So on the non-financial highlights, showing again that the structural demand we are seeing, we're able to capture as MTN, particularly around data and fintech services. Just to cover some of the financial highlights, and Sulu will take us into all the detail, I'll just pick up on some of the key areas. We're very encouraged with the solid performance on service revenue in a heightened inflation environment that we saw. So we achieved 15.3% service revenue growth at a time that we would have experienced inflation at around 15.1%. So we still eked out service revenue growth above inflation. This time, the average inflation of the prior was actually more like 11.5%. So good growth on service revenue. If we go to the EBITDA margins, operational results is that we basically maintain the EBITDA margins slightly diluted at 0.1%. And Sulu will take us through a view of that. But if you look at all the markets that added to EBITDA margin, South Africa was down 0.1%. And the drag actually on EBITDA margin would be in some of the head office lines, and Sulu will take us through that. So the operational prints on EBITDA margin actually on the portfolio has been very strong. Earnings growth, underlying earnings growth at 18%. We saw ROEs expand to just on 23.4%, and we declared a dividend for financial year 2022 in line with the commitment that we've made on 3.30 cents, so that's 10% up. And as I mentioned earlier on, the leverage is at a pretty much at an all-time low, certainly in the last 6 years that I've been here, that we're seeing the leverage at 0.8 times and 0.3 times, and the liquidity of the company is also very strong at 60 billion. So we'll take us through the results in a lot more detail, but these are very pleasing set of results driven by this unique growth engine that MTN has in terms of its scale, its the strength of its networks, the brand, as well as the market positions that we have across all our markets. But looking into the year under review and unpacking a little bit of the macro context that we operated in, 4 big forces that we had to deal with as we navigated 2022. The first set of forces are really around the macro, supply chain, regulatory, then energy and power. And I'll pick up some of the salient points. On the macro, I think enough has been said around this elevated inflation environments that we operated in. I think you will note that a market like Ghana, inflation ended up at 50% as well. South Africa was more like 7.6% and South Africa 21%. And then we had local currencies weakening against the US dollar, and also the availability of US dollars in several of our markets were a challenge, in particular Nigeria, but we were able to still get upstreaming during the period. On regulatory, 2 big forces that we had to deal with, the SIM registrations both in Ghana and Nigeria. And as we worked through the year towards quarter 3 and quarter 4, these were well managed. And then the big factor that really impacted 2022 was really around the situation on load shedding in South Africa. And I'll cover a bit more detail on our outlook on load shedding. The first half of the year that we saw in South Africa had relatively de minimis amount of load shedding, and we did highlight with the H1 results when we released them that if we saw heightened, elevated load shedding, that would impact service revenue development as well as margin, and that has come to pass as we had anticipated it would, and I'll give a bit more detail exactly how we dealt with that situation and how we're looking going forward. So just our strategy to navigate the environment that we were operating. These are the 4 major programs that we spoke to investors at the half year that we would tackle. There were commercial objectives, supply chain network, as well as financial resilience. And we've kind of, marked our own homework a little bit here to show how we thought we did in the year under review. So on commercial, this was really about to scale up on CVM, particularly within South Africa, but more broadly, as well as to optimize pricing. And in part, some of that price optimization was increases in headline pricing. We brought some of that through several of our markets, and I think the ones that are most notable is we made progress in Ghana, both for data and for voice. South Africa, we have announced relatively modest price increases on the postpaid side that are under implementation. And then in Nigeria, we had secured a price increase that was reversed. We still are highly committed and engaged on that one because we think it's essential that we bring that through. So that reflects the rating that we put there. On device management, in South Africa particularly, H2 was better than H1. But as always, with the increasing dollar to rand exchange rate, we kept it at amber. Supply chain, I think things were very well managed within the context of last year. And then on network, we have been engaged in reviewing some of our towerco contracts, and then we are in implementation of the SA Power Resilience Program. We put a little red ring around the yellow. The yellow is really against our own 4-stage network resilience plan. But the red is showing that actually the second half of the year, in terms of load shedding, was much more significant than we had anticipated. And I would argue that the broader South African had anticipated, where we saw sustained levels of load shedding above stage 4. And that is much more what that red ring encompasses. On the financial resilience, we're in excellent shape in terms of the balance sheet. As I said earlier on, the leverage is very comfortable, 0.8 against a target of 1.5 times, ample liquidity that we have, and we managed to execute on our liability management program. We said we wanted to tackle particularly the Eurobonds, which are in 2024 and 2026, and last year we were able to early settle $300 million of the 2024 bonds, which now leaves about 450 that we would like to work on in the course of this year. And so very good progress around the balance sheet and the shape and the mix of debt that we have. So we feel pretty pleased with the financial resilience initiatives that we delivered in the year. Just coming to the markets and picking up some of the salient points, obviously in South Africa, the big issues were really around load shedding and the impact that had on our network availability. The other issue is that with heightened inflation, we saw quite a lot of pressure on the consumer, particularly on prepaid customers. Charles is here and Dineo. They're very willing and able to answer any questions you may have around that. But we continue to focus on investing in the network, spent 8.8 billion rand of capex investment, strengthening our position on our 4G networks, as well as expanding on 5G. Just under 600 new 5G sites, giving us a total population coverage as at the end of last year, about 21% 5G population coverage. So well done to Charles and co in that regard. The securing of 100 megahertz of multi-band spectrum was also a major milestone for the OPCO. That gives us also now the frequency assets to enable us to expand coverage, but also over time to bring the cost to communicate in South Africa. And as I mentioned earlier on, a lot of focus and initiative really around network resilience in execution. On some of the results we delivered, and Tsulu will talk to it, we saw very strong net additions, so 1.5 million net adds in the period, and subscribers growing by just on 4.4% to just over 36.5 million. So all in all, under very challenging circumstances, good growth from the South African business, and Tsulu will cover the financials. Just a little bit on the load shedding impact, and I'll talk to our outlook, in the look ahead section. It's important to discuss the context. So we had 208 days of load shedding in South Africa last year. 62 days of them were actually in H1, and the kind of mean level of load shedding was well below 4. What we saw in the second half of the year was 146 days, and just in the last quarter is 3 months, 91 days of load shedding. And as we'll discuss in the outlook, that load shedding in the second half was actually at a sustained level at stage 4 plus. And we are taking the view now that we believe that given where the energy availability factor is in South Africa and all the initiatives, that it is prudent for us to take a view that stage 4 plus is what's going to be with us on a sustained basis, certainly over the next 3, maybe as much as 5 years, and hence we've made the decisions around our target margins. So this has obviously impacted availability of the network, impacted the revenues as well as costs, and as the headline shows, that our estimate is that the earnings impact was about 695 million, or to service revenue, actually about 1.6 percentage points to service revenue. Those who want to add back these things would have seen that the underlying operating momentum within SA would have been well above 5% service revenue had the load shedding impacts not come through. Again, what did we do? We focused a lot, Charleston team focused a lot on executing our 4-stage resilience plan. We added batteries to to our sites. And if you were talking about what batteries to deploy, probably this time last year you'd have been talking about putting in batteries that really have a 4-hour and needing 4-hour recharge cycle. Today we're talking about 6 to 8 hours are needed in the kind of battery deployments. And we're also now talking about gen sets being required, not only just on hub sites and switches, but also on some of our sites. So there's now a push also towards gen sets that we are implementing, and Charles can cover some of that in Q&A. So that's South Africa in terms of what was the focus area for 2022. Nigeria, under very challenging macro conditions of elevated inflation and having to deal with a NIN registration, I think these were very excellent results delivered. 21.5% is the service revenue delivered against a blended average of 18.8. We saw key activities, accelerating 4G, network coverage, as well as launching 5G. So congratulations to Carl and his team. I think we're seeing a very sustained level of growth in that market, and we're seeing the EBITDA margins being achieved, well within the guidance that we've set ourselves. And the other key point in the results has been the launch of Momo PSB, which we did in May 2021, and we've seen good progress, seen the NIBs switch now being open for both inbound and outbound, which is encouraging us as we look ahead for 2023 and seeing the acceleration of Momo PSB. If I talk about the other markets, again, a very pleasing set of results broadly across markets. I think there are some key features, very strong data growth across all regions, SIA, WECA, and MENA. I think that's a feature. And as I mentioned, the operational EBITDA margin, when you look at them on a collective, they all were accretive to the EBITDA margin growth that we saw across our markets, and Tsulu will take us through a little bit of that detail. Important too to see the Fintech recovery, particularly in Q4, where we saw very strong recovery for a market like Cote d'Ivoire. We had always said that Cote d'Ivoire, under the competitive context of a new market entrant, that we're going to be very disciplined with our strategy and deploy it, and that 15-month response strategy came to an end in December, and as we had predicted that we would be back in growth, and we saw Q4 actually for Cote d'Ivoire 7.7% growth as we lapped out some of the P2P price cuts that we had taken. So we're seeing very good growth in that market. We're seeing very good growth in Uganda and Rwanda, and also in Ghana, where we had seen the e-levy coming out, the 1.5% e-levy coming out in May. It has been reduced now to 1%, which has been encouraging. But the business has continued to see, particularly in Q4, very strong and resilient, fintech growth across our markets. On MENA, 2 points to mention. MTN Irancell is obviously an associate, where we have a 49% shareholding. Again, the underlying growth of earnings in that business has been very strong in a very challenging macro environment. So just under 66% earnings growth. If you look at actually the EBITDA margin expansion, it looks more like 400 basis points, and that's in a very challenged macro where you're seeing inflation, very close to the 50%. So very pleasing growth. And Snap, which we always position as the Uber of Iran, again, that is a little gem of a business within that market that now has 4 million rides a day. 2 years ago, we're talking about 3 million, so that business has continued to expand over time. Just on the fintech side, again, we focused a lot on the ecosystem effect because we think that over time, the ecosystem is what's going to drive the value creation over time. So our investment into a fintech ecosystem and its expansion, we believe, is what will enable us to monetize the opportunity that we see. Obviously, we've seen very pleasing growth in the subscribers. So now we're at 69 and well arranged to get to 100. But I want to call out actually a major trend that happened through last year, which is that merchants have now overtaken agents in the year. So the merchant was almost doubled in the year. And we're pushing Serene and the team to get to at least 3 million. Serene knows I'm always pushing for a target above the 3, which I think is actually more achievable. And we've always said that actually the real effect of mobile money or the fintech is where the acceptance is pervasive across markets. And what enables that is that we've got to sign on more and more merchants. And I would argue that that is one of the real success stories of the year under review, which is the merchant expansion, which we're kind of halfway there towards our 3 million target, as we've got another 3 years to go on the Vision 2025. 2 other points I would make is the fintech structural separation, intercompany agreements, largely complete. There's a very detailed and involved exercise, which has taken our legal team, our M&A team, as well as the finance and tax teams, led by the respective executives, to drive that kind of market by market. It's not a very straightforward process, but we've made very good progress. And I would argue that those intercompany agreements are largely in place and are being effected. And the other point that we raised in the results release is that we have received offers that we believe are compelling towards minority investment within the fintech space, and we are engaged with those potential strategic partners over the next 6 to 8 weeks to try and get to a conclusion point, as we had announced the process at the end of Q3 last year, that we had actually got into that process in a lot of detail. So those are the points I would make really around the fintech space. On the portfolio transformation, as I mentioned, we've now got shy of 19 billion rand achieved against our 25 billion rand target. 12 billion of those proceeds actually last year. In a very challenging year, we're able to get that underway, predominantly driven by the sell down in Nigeria. We had also a sell down in Ghana, and then the tower sales to IHS also came in the year. And when you add all of that up, that's what makes up the majority of your 12 billion. We remain committed, to look at continue the ARP into the future. What has held us back, particularly in Nigeria, has been obviously the paucity of FX. So we've pulled back on that, and we anticipate, subject to foreign currency being easily available, that we would pick up on that activity or further sell down in the second half of the year. But that's obviously subject to market conditions. And then obviously IHS at these current valuation levels, we think the asset is fundamentally undervalued. So, we don't have any plans right now to sell anything, in terms of our shareholding in IHS. We're far from what we think fair value is. And for now, we'll hold our position and particularly given the fact that the balance sheet does not need us to make any sales right now, given the comforts that we have. But we'll continue to make progress around the portfolio transformation, and in the outlook, I'll make a few more comments around that. Then on creating shared value, we always framed it under 3 objectives: our eco-responsibility, sustainable societies, and sound governance. And to talk to some of the KPIs, how we achieved. So on reducing greenhouse gas emissions, excluding South Africa, we got to 12.3 times. We actually had an internal target, which Nompilo and them sometimes say, don't talk about internal targets, just, but we do have an internal target. For last year, we had an internal target of reduction by 3.5%. So it's very good to see that we delivered 12.3, excluding SA. And obviously SA, because of the amount of backup power and diesel, SA, lagged the plan that we had. In terms of broadband coverage, again, comfortably in line towards meeting our targets, and we're making good progress on diversity and inclusion at 40% against our medium-term target of 50%. And in terms of economic value added, we believe that we're making a contribution to societies more broadly, particularly around the capital investment that we're putting into our networks and IT, the platforms that we run. Before I hand over to Tsulu to take us through the numbers, just an assessment of where we are against our medium-term guidance. We are encouraged by the progress we've made under very challenging market conditions. As I said, South Africa was a tale of 2 halves. H1, we had service revenue of 4.1. The print on H2 is 3 to give us the blended rate on 3.6. And that is effectively largely due to the intensity of load shedding and the progress we still need to make around ensuring that we have the appropriate batteries and backup power across pretty much all our sites. On accelerate fintech platform growth, this is a ratio, so in the denominator is both voice and data. And what we often reflect on is, at the time we put our targets, we're anticipating that voice would be kind of very low growth, maybe 1 or 2 percentage points. Today it's still 4%, and that data would have been around 25%. You saw data at 33. So the denominator is still growing when we thought it was going to shrink. So it's a bit of a nice problem to have. And then in the numerator, the taxes, particularly in Ghana, Cameroon, and Benin, kind of slowed the monetization of the transaction activity that you saw. But as we look towards Q4, we are very encouraged that this is a KPI that we should still push towards. We see 20% already achieved and exceeded in SIA. We see in WECA it's 16.7. So we believe the portfolio effect for MTN over the medium term should be able to push towards the 20%. I won't talk much about asset realization. As I said, we're still going to push to get towards greater than the 25 billion. And the ROE has been a very pleasing result to see it now at 23.4. In 2018, that number was 11.5. So almost doubled in the space of 5 years. So showing that the capital we're deploying is driving return accretion over time. Let me now hand over to Tsulu, and I'll come back after a presentation to give some views on prospects and guidance.
Thank you very much, Ralph. A very warm welcome and good afternoon to everyone joining us for the results, and a special yellow to all our MTNers joining us in various platforms and those that are here with us this afternoon. I'm pleased to present to you the financial performance overview for the year ended 2022. I'll first start by just highlighting some of the key material items and significant ones-off items that impacted our results. I will then cover some salient points on our group income statement, and then I will share with you the performance of 2 of our major subsidiaries, being Nigeria, as well as South Africa. And I will also share with you how we have utilized sources of cash generated, how we've improved the balance sheet, as well as improved return on equity. So if I can briefly touch on the material items that have impacted our results. Firstly, on the macroeconomic environment, you'll see that our markets are really subject to forex volatility. We also saw the rand on average exchange rate performing stronger against other currencies in the markets that we operate in, with negative impact on the reported service revenue growth rate compared to the constant currency growth rates. But it closed weaker against the US dollar as well as the euro, and thus impacting the balance sheet items as well as holdco leverage. We also had some forex impacts of about 5 billion that has impacted our finance charges, which I will share with you later. Secondly, our numbers were also impacted by rising inflation and high energy cost due to the macroeconomic environment that we operate in, which really resulted in upward pressure on our operating expenses. Our group blended inflation, as Ralph indicated, averaged about 15.1%, and this was comparing to 11.5% in 2021. Other significant items that impacted reported results were the goodwill and asset impairments on two of our subsidiaries, Afghanistan as well as Guinea-Bissau, and two of our associates being Mawali as well as MEIH. We also recognized a net accounting gain on disposal of SA Towers of about 405 million, with net cash proceeds on disposal of 5.1 billion. This year, we also had a remeasurement on our deferred tax asset in Mauritius, where we took a reassessment of the recoverability of the asset in the balance sheet in light of current market conditions as well as the macroeconomic environment. So based on this, we remeasured the deferred tax asset and reduced the balance by 1.2 billion rand, thus taking that loss. These significant items obviously have had an impact on our expenses, our EBITDA, our EBIT, as well as our headline earnings per share. If we can then move on to the group income statement, just on the last two columns on the slide, we show the movement of reported as well as constant currency year on year. As indicated, we've delivered service revenue growth on a reported basis of 14.4 billion to 196 billion, and about 15.3% increase in constant currency to 194 billion rand. And this was in line with our medium-term guidance. This was also largely driven by the double-digit growth that we saw in both Nigeria as well as Ghana, and all three of our regions, as Ralph indicated, delivered healthy top-line growth, thus contributing to our overall service revenue growth. On a reported basis, EBITDA before one-off items grew by 12.4% to 90.8 billion rand, but in constant currency increased by 14.3% to almost 90 billion, and also largely driven by healthy operational results across most of our markets. The increase in depreciation, amortization, as well as goodwill impairment was moderated at 1.7%. We saw an increase in depreciation due to capex additions as well as the goodwill impairments, but these were sort of set off by the disposal of towers in MTN SA, where we had to discontinue the depreciation. Net finance cost increased by 24.4% in constant currency, and this was largely driven by the forex losses, as I indicated, 5 billion rand in forex losses, of which some of it was due to losses from driven by cash upstreaming, mainly in Nigeria. We also saw increased borrowing costs, particularly in Nigeria, from funding activities, refinancing, as well as due to interest rate hikes. The share of results from associates and joint ventures increased by stellar 64% to 3.4 billion rand, and this was largely driven by the strong underlying performance from MTN Irancell. The income tax expense, as you can see, grew by 45.8%, largely due to higher withholding taxes, the taxes paid on the sale of towers in South Africa, the remeasurement of the deferred tax asset in Mauritius, as well as the increase in non-deductible expenses. So as a result, we had a reported group effective tax rate of 41.5% due to the remeasurement of the deferred tax, the Nigeria education tax as well, Ghana special levy as well, together with the withholding taxes, which really increased the group effective tax rate. But on a normalized basis, the effective tax rate was at 37.1%. There was also a significant increase in non-controlling interest, up 51.8% during the period, and this was primarily due to our localization in Nigeria, Ghana, as well as Uganda. Adjusted headline earnings increased by 18.3%, which was impacted positively by the adjustment on non-operational items, totaling 159 cents per share. I will now just unpack our group service revenue in a bit more detail. As we can see, data was the biggest driver of growth, followed by solid growth from Fintech, as well as SMS and ICT, with voice showing still healthy growth. We continue to see this healthy growth from voice, which was up 4.2%, really supported by the voice traffic growth of 3% year on year. The main contributors again were Ghana and Nigeria in terms of voice revenue growth at 23.8% from Nigeria and Ghana, 23.8% from Ghana and Nigeria 6.9% increase. But these were set off by the decline that we saw in South Africa due to load shedding impacts, but also the tough macro affecting the consumer. Data revenue growth, as you can see, increased by 32%, with Nigeria and Ghana again showing the biggest growth at 48% and 42% respectively, driven by strong data traffic growth of 33%, underpinned by 12% increase in active data subscribers. Fintech revenue grew 14.3%, driven by base growth of 21% to 69 million active Momo users. Wholesale, on the other hand, grew by 12.8% with steady national roaming performance in MTN South Africa specifically. Other revenue, which mainly comes from SMS and ICT, grew 20.5% from a group perspective, and this was largely in markets like Nigeria as well as SA. So before I continue with other elements of our group performance, I would like to just touch on the financial performance of SA Nigeria, starting with South Africa. On this slide, you will see that MTN South Africa delivered service revenue growth of 3.6%, as we indicated, really enabled through commercial and operational execution discipline across all the business units. So if we unpack this further, you'll see, as an indicated, voice revenue was down 8.8%, largely due to network interruptions from load shedding, the general macroeconomic environment, but we're also starting to see customers moving over to voice over IP and as well as data substitution from traditional voice, so increasing, having an impact on voice. But we saw an increase in data revenue of 13%, supported by data traffic growth of 33% in South Africa, with active data subscribers growing by 7%, totaling 18.9 million subs. On the Fintech side in South Africa, which comprises of airtime lending fees, we saw a decline here of 2.8% as customers prioritize more spend due to economic pressures. But MTN SA continued to scale up its Fintech ecosystem, now with about 1.2 million users, up 105% year on year. Wholesale revenue was up 6.3% in South Africa, supported by national roaming deals, particularly with Cell C as well as Telkom. Following the completion of the Cell C recapitalization, we saw MTN SA moving to an accrual basis of accounting for national roaming services. We recognize revenue of about 2.7 billion rand in this regard, which was an increase of 2.1%. Looking at the expenses in South Africa, you will see that cost of sales grew by almost 8%, largely due to an increase in device costs. The device cost of sales went up by 9% due to the increase in subsidized devices to remain market competitive. Device gross margins also declined by 3.2 percentage points as a result. Commission and distribution expenses also went up 6.3% due to increases in device distribution as well as activation commission. When we look at operating expenses, we saw that it largely remained flat with a 0.5% increase overall. The marginal growth was achieved despite an increase in network cost predominantly in rent and utilities as well as maintenance, which grew by 22% for the year. And this was due to management response on expense efficiencies, which offset the significant cost growth. But last year, we also had a significant increase in terms of the share-based payments. Additional expenses for generator fuel due to excessive load shedding impacts also had an impact on the operating expenses line. So when we look at MTN SA's EBITDA, we see that it declined by 0.4 percentage point to 38.5% for the year. But the EBITDA margin decline, as I indicated, was driven by lower than expected service revenue performance, as well as increased cost of sales amidst continued focus on cost efficiencies. South Africa spent 8.8 billion rand in capital expenditure, excluding IFRS leases, with a total capital expenditure, including leases, of 15.3 billion rand. And this also, the 15.3 billion rand included about 5.1 billion from the sale and leaseback of the towers portfolio. And this was really, when we look at capex excluding leases, this is really in support of continued investment in 3G and 5G, in 3G and 4G, as well as the rollout of 5G, as we indicated earlier. Just under 600 of 5G sites were rolled out during the period, with capex intensity of 17.4% ex leases for the period. Just on this side, the business units within South Africa, unpacking the service revenue a bit more, you can see that the consumer prepaid business grew by 0.3 percentage points, 0.3%, and this was supported by strong data consumption, partly offset by the pressure that we mentioned on the voice revenue line. The consumer postpaid business grew by 3.2% in a challenging environment, driven by the growth in subscriber numbers and the sustained uplift on data consumption. Enterprise service revenue grew by 17.5%, really sustained growth there, supported by growth in mobile data revenue, bulk SMS, as well as IoT. If we can then move on to MTN Nigeria, which has already reported its results in January, so I will just briefly touch on salient items. We can see that it delivered a solid performance with double-digit revenue of 21.5% ahead of the blended inflation, as we indicated earlier. And the main drivers of growth were in voice, data, fintech, overall. Voice maintained a steady recovery at 6.9% growth, and this was really impacted by the reactivations as more customers' SIMs were reactivated, as well as the gross connections ramping up following the implementation of this NCC directive on NIN-SIM registration. We saw strong data revenue growth as well of 48%, as I indicated, underpinned by increased usage from the existing base, with impressive data traffic growth of 67% overall, supported by the acceleration of 4G sites rolled out. Fintech revenue had commendable growth as well of 19% during the period due to sustained growth, particularly in the use of extra time, which went up by 18%, and the broader use of the fintech services by customers. In terms of total expenses, we see a total expense increase of 21%, with cost of sales growing by 25.6%. And this was largely driven by higher commission and distribution costs of 23% due to increased airtime sales and activation commissions. We also saw aggressive data device sales growth relative to last year, following the lifting of the ban on the SIM sales. Regulatory fees were up 31.5% due to the growth in revenue as well. When we look at OPEX, we see an increase of 18.9%, broadly in line with inflation, but really due to higher network operating costs from accelerated site rollout. The devaluation of the Naira as well as CPI impacts had an impact on the BTS rentals, thus increasing the network operating cost. MTN Nigeria continued this year as well with its expense efficiency saving, which was aimed at driving the margin expansion, and we saw an improvement in margin of 0.2 percentage point during the period, with margins at 53.2%. So this was really despite the impact that they saw on the rising inflation as well as forex devaluation. On the capital expenditure side, MTN Nigeria spent 13.7 billion rand for the period excluding leases, and this was, as we indicated, due to accelerated rollout of 3G and 4G sites, with capex intensity excluding leases of 17.7%. If I can touch off our group fintech revenue before I move to other items, you'll notice that group fintech revenue now contributes almost 9% to total group service revenue, with a growth of 14.3%, as I indicated. The growth in fintech revenue during the period was impacted by the introduction of e-levies and momo taxes in our markets, as Ralph indicated, as well as pricing pressure due to increased competition. But despite these challenges, we are pleased that we managed to maintain a solid growth in active users of 69.1 million active users. We started seeing a recovery as well in the last quarter in markets like Ghana, as well as Cote d'Ivoire, following significant decline at the beginning of the year. The bulk of the fintech revenue services, as you can see from the pie chart, is really from withdrawal at 55% of the fintech revenue, which declined from 59% in 2021, while advanced services contributed about 15% now from 10.5% last year. So we saw payments and e-commerce growing by 69%, as you can see on the bar chart there, year on year, with Fintech having an increase of 50% overall, and remittances showing an increase of about 73%. So although these are still nascent, we're encouraged by this increase as we are starting to see these advanced services growing, which is really in line with our goal to have more of these advanced services relative to the basic services. So as Ralph indicated earlier, we are on track with our structural separation, with intercompany agreements now in place. So the process of allocating the costs is really underway and largely complete. So as we indicated previously, this will be a process of margin evolution until the fintech business moves to being a standalone business. If we move on to the group expenses, and now turning to the group expenses overall, you can see that it was well managed given the challenging macroeconomic environment. Group cost of sales, as you can see, increased by 13%, largely driven by an increase in commissions and distributions, as well as increased handsets in markets like Nigeria and South Africa, as I indicated. And then when we look at the operating expenses, we can see an increase of 14.9%, and the main impact, as I indicated earlier, was due to the network operating expenses, which contributed 17.7% of the total cost. And as a result of the increase in the number of sites rolled out, high inflation, load shedding impacts in South Africa, as well as high energy costs due to the macro, we saw a significant increase there. OPEX growth was also driven by high litigation costs at head office, as we deal with many litigation items, an increase in professional fees for strategic projects that we are doing, as well as marketing campaigns as we continue to accelerate our Ambition 2025 initiatives. So just in terms of the measures that we have taken to cap the inflationary impacts, we've continued with our expense efficiency program, which we started just over 3 years ago, where we gave ourselves a target of in excess of 5 billion rand of a 2020 base, and we have achieved so far 6.4 billion rand since then. During this period, we realized about 2.7 billion rand worth of efficiencies, and these were mainly from Nigeria and South Africa, which made up 2/3 of those savings. And these were mainly in the areas of mobile network, sales and distribution, general and administration expenses in the main. We also had some good savings from our IT optimization as well. So the total cost to revenue ratio has broadly been in line with what we expected, given the fact that we are operating in high inflationary environments, and we're quite happy that we've been able to achieve those efficiencies under the circumstances. So we are really pleased to have seen the results of our EEP yielding this result, really enabling us to be able to cap the inflationary pressures, and we will continue with these cost efficiencies as we move forward. In terms of the group EBITDA margins, group EBITDA, as you can see on the next slide, just to indicate that in this slide, I just show the absolute terms of EBITDA as well as the group margin. Overall, group EBITDA on underlying operations was up 14% in constant currency to 90 billion. This growth was really broad-based, led by the performance of Nigeria, the worker markets, as well as MENA region, as we showed earlier on. The group's reported EBITDA margin remained largely steady at about 44% before once-off items. This was on the back of top-line growth as well as the disciplined execution of our expense efficiency program. So we had positive contributions from all markets except in South Africa, where the margin was impacted by the device cost as well as additional expenses due to load shedding. Head office eliminations of about 1.8 billion rand impacting the margin was mainly due to lower reversals of the price share performance provisions in this year, in the current year compared to last year, and this was due to share price movements. We also had a loss of consolidation of IO for the full 12 months of 2022 versus only 6 months in the prior year. And also we had an overall impact of 280 million on our MTN insurance business due to higher bad debts and lower contribution this year relative to the previous year. So these were just some of the impacts on the margins. If we then move on to our adjusted headline earnings per share analysis, this table provides a reconciliation of the attributable earnings per share through to adjusted headline earnings per share, which gives more visibility on our operational performance. The difference between the attributable earnings per share, which grew by 40%, as well as the basic earnings per share, which grew by 16.9%, is due to the significant once-off items that I mentioned earlier. You will see that the Afghanistan impairment there had an impact of 70 cents per share, which was a write back, and then the net gain on disposal of SA Towers of 22 cents per share, and disposal of other PPE, and as well as other material items in the previous year, such as the derecognition of Syria and the acquisition of IO, which we didn't have this year. So that's impacting the basic headline earnings per share. So if you do add further adjustments to the headline earnings per share for hyperinflationary impacts as well as forex losses and the remeasurement of deferred tax asset that I mentioned earlier, as well as the divestments, meaning the sell downs, you will notice that we had an adjusted headline earnings per share of 1,313 cents, giving us an increase of 18%, which is really an indication of positive underlying operational earnings momentum under really challenging macroeconomic environment. If we then move on to our capex or profile, as you can see, we capitalized about 38.2 billion rand during the year across all the markets, achieving an 18.5% capex intensity excluding leases. So the macroeconomic conditions in markets like Ghana and accelerated rollout in South Africa, Nigeria, and markets like Sudan resulted in that higher spend. As we said, we rolled out just over 3,500 in 3G sites, over about 7,900 sites of 4G, and accelerated our 5G sites mainly in South Africa, adding a total of 1,570 sites in this year. We now have just over 2,500 in 5G sites. So we really focused on investing in faster growth areas where we accelerated capex to also mitigate the supply chain shortages that we saw and anticipated, as well as the foreign exchange volatility. Network connectivity capex, as you can see, which is mainly the RAN equipment, the radio access network equipment, the transmission, the core, as well as the site infrastructure, accounted for 77% of the total capex, while investment in IT, which includes the development of product tools to support our growing platform business, accounted for 23% of the total capex. Looking forward, we've given a guidance of 37.4 billion rand for 2023 to really support the accelerated growth that we are seeing, but we'll maintain our medium-term target in the range of 15 to 18% in terms of capex intensity on current currency assumption. If I can move to our operating free cash flow, you will see that we had operating free cash flow before spectrum acquisitions declining by 20.7%, largely impacted by the accelerated capex, the pressure on working capital due to advance payments we made to vendors to cap against impact on forex, as well as advance ordering of material to manage supply chain shortages. Spectrum acquisitions in Nigeria and SA made up about 8 billion rand, and that had an impact of 30.5 billion. In the year, we also saw 1.4 billion rand in working capital outflows, largely due to the timing effects relating to payment to vendors and suppliers, mainly in Nigeria and Ghana. But this was cushioned by the cash release initiatives that we implemented, mainly in MTN South Africa. So the key outflows in cash outflows included taxes paid of 14 billion, as you can see, which also included taxes on the disposal of SA Towers of about 1.3 billion rand. We had net interest paid on borrowings of about 12.5 billion rand, and payments for capex of 38 billion rand, which included some capex relating to prior year. The dividend paid to group shareholders and minorities amounted to 9.1 billion rand. We also had movement in financing activities of 8.3 billion rand, which was largely driven by the net outflow of borrowings of 3 billion rand, as well as the settlement of lease obligation of 7 billion rand for 7.4 billion rand. So we had new borrowings of 25 billion rand, which was offset by the settlement of a debt of about 28 billion. And this was impacted by also the net inflow of about 1.8 billion rand, mainly from the proceeds from localization, as well as purchase of set off by the purchase of treasury shares. Other investments of 2.4 were driven by the gross proceeds from the disposal of SA Towers of about 6.4 billion rand. This was also impacted by the outflow of restricted cash, mainly in Nigeria and head office, as well as short-term investments at head office of about 800 million. The other that you see there relates to cash balances in Afghanistan that had to be classified as an asset held for sale and reduced their group cash balances. The impact of forex, as you can see, reduced our free cash flow by 2.1 billion rand, but we ended the year with healthy free cash flow despite of 4.6 billion rand. Looking at our holdco debt, we continue to improve the strength of our balance sheet with progress in cash upstreaming, as well as faster deleveraging of the holdco. On the top left-hand side, you will see the progress that we made in the last 4 years, where we had a net debt from 55 billion rand, now reducing to 23 billion rand. The group leverage improved to 0.3 times, supported by strong cash positions, while the holdco leverage improved to 0.8 times. Holdco leverage was positively impacted by the progress that we made on our cash upstreaming from markets, as well as the early part payment of the US-denominated 2024 Eurobond that we concluded during the year under liability management. We also made some substantial improvement in our debt mix, now sitting at 64% of our debt now being ZAR denominated against our target of 60 to 40. This is aligned to our focus of really optimizing that currency mix, as well as mitigating the refinancing risk by smoothing and lengthening our debt maturity profile while maintaining a healthy liquidity headroom. So the prepayment that we made of the portion of the Euro bond for 2024 was really a massive improvement in our strategy to substantially reduce the dollar-denominated bonds in line with our capital allocation framework of faster deleveraging the whole core balance sheet. We did pay about $300 million US, and we still have about $450 million of the Euro bond 2022. And we will explore opportunities to settle the balance as subject to market conditions as well as successful RFP, so that we can flatten that Manhattan-like debt maturity profile that we see on the top right-hand corner. Just moving on to the last slide, return on equity. We see an increase from 19.6% in December 2021 to now 23.4%. And this was really driven by operational earnings growth from the consolidated subsidiaries. The notable drags that you see on return on equity were due to higher taxes, due to higher profit before tax, as well as the deferred tax asset credit of about 1.4 billion not recognized that I mentioned in my earlier slide, versus relative to when you compare to the previous year, as well as the movement on a non-controlling interest, which was driven by the reduction in shareholding from the localization. Included in other non-operational items was largely attributable to movements directly in equity. Items that impacted that ROE positively were the FCTR's foreign currency translation reserve movements, mainly from the devaluation of the CD in Ghana. We also saw a revaluation of the IHS portfolio due to decline in the share price, thus boosting the ROE. But this was also offset by the movements in distributable and revaluation reserve, an amount of about 2.8 percentage points, as well as localizations with minorities. So we're really pleased to see this ROE evolution, which is improving towards the 25% that we have guided the market on. Ladies and gentlemen, that concludes my presentation. I'll hand over to Ralph.
Thanks very much, Tsulu, for taking stakeholders through a very detailed set of financial results. A lot that's going on there, and trust that you have a better understanding of the performance in the year under review from a financial perspective. Let me spend a few minutes talking about prospects and guidance as we think about the year ahead and potentially also into 2024. The macro context that we see for 2023 remains one that of uncertainties, particularly around the markets that we operate in from a GDP growth perspective, inflation, currency, and commodity prices. Across sub-Saharan Africa, we anticipate that growth will be subdued, given the levels of elevated inflation. And many of these forces are driven by the broader geopolitical considerations that we're seeing in other markets. We anticipate that inflation across our markets will remain elevated, but slightly down from where they've been in last year, given base effects, and that we'll still see some level of currency volatility and depreciation across our markets. And I'm sure these are views that you've all developed. I mean, our sense is that it will be a very tough 2023, but H1 tougher than H2, and I'll explain some of our thinking around that. And the big issue that we then see is really around the load shedding effects in South Africa, which I just want to expand a little bit on in my next slide. If we look at this chart, this is a chart that looks to provide since the 1st of January 2022 to the 28th of February 2023, a kind of daily mean stage in terms of load shedding across the various months. And maybe a couple of points to pick up on that chart. The first is that in the first half of the year, as I mentioned, we had 62 days of load shedding, and you can see that the load shedding effects were relatively de minimis in the first half, and we delivered 4.1% service revenue, and hardly got to the kind of stage 4 that we are talking about, that we anticipate being sustained over the medium term. And then you look past July, and then you get into September, and then you start seeing, a different form of Manhattan, which is one where you're seeing sustained levels of load shedding, generally above level 4 upwards. And if you go back 2 years ago, most market commentators, and I guess including ourselves as market participants, would have seen stage 4 is actually almost at the level of force majeure, whether it's the batteries that you deploy or the contracts that you signed. Now, we have a power as a service set of agreements that are framed from stage 4 as the force majeure. And if we say that we're seeing sustained stage 4 and above, obviously it's framed our thinking about the outlook and how do we need to think about our investment profile in SA, as well as how we think about the margin. So the first point that we want to make is that we anticipate that H1 for South Africa would be a very tough period, both at the service revenue end as well as at the margin end. But with a recovery coming into the second half of the year, as our rollout for our 4-stage resilience program comes to completion, and we have pretty much all our sites secured with backup batteries, as well as selectively deployments of gensets. And that program is still in execution. It's not completed. And once it's complete, I think it will give our network a level of resilience. We have over 80% of our sites having had batteries, so there's a 20% at the battery level. But we believe that the responsible thing is actually to deploy genset within the network, because we don't believe that you're going to see stage 4 and lower, as we experienced in the first half, actually going into subsequent periods. So we're putting additional network resilience to secure the network over this calendar year, so that subsequent periods, we have a relatively stable network. Now, the medium-term guidance, we've said that we're keeping service revenue at the original mid-single digits, that is 4 to 6%. We believe that our activity around CVM, which is progressing, and our price optimization, including headline pricing, we're reviewing headline pricing around prepaid as well, that will help us, stay within the 4 to 6% corridor. But I think you should see the accretion towards that 4 to 6 in the second half of the year. In terms of the margin itself, we had previously guided 39 to 41. So people say, what happened to my margin? So the way to think about it is stage 4 and below, that was in the 39%. There's a component of PAS that would have been there. But at stage 4 and above, there's certain costs that we then pick up that actually start impacting the margin directly. We pick up some of those costs, and some are with IHS as the main provider of power for us across our markets. So how should you de-aggregate that 39? The way to think about it is, firstly, within the 39, there is a level of PAS there already, so let's just lock that down. There is another 1.2 percentage point that has basically 3 components. The additional power that we would pick up above stage 4. The electricity tariffs are going actually double-digit. I think you've got to factor that into the environment. Is, do you anticipate the electricity administered pricing to be something below double-digit? We're saying it's going to be above double digits. It's in that 1.2, and there's obviously additional security arrangements that we have across. So that's your 1.2. There's a 0.8%, which is the new management agreement that we've put into MTN. For those who are looking for a clean operational margin, you might want to back that out to say, well, the 0.8 is basically going back to the group. It's cash that's going back to the group in a different form. It's now in the form of a management agreement. That's the 0.8. So for those who are looking at a pure kind of operating print, the impact is actually about 1.2 percentage points. The other 0.8 is really management fee, which is we are in a process of looking at our management fee agreements across all our markets and implementing revised management fees, given the value that the opcos are getting from the group. And this is a revised fee agreement for SA. So those purists who are looking for the print, back that 0.8 out. So we do think the responsible thing now is in the medium term to target that 37 to 39. But South Africa is a business that generates really good cash flow that gives us a strong underpin, particularly to the dividend that we commit to. So on the cash generation of the business, I think you should see that that cash generation remains healthy and supporting a lot of the activities that are happening at the group level in terms of interest payments, as well as actually paying a material portion of the group dividend that we end up declaring. So I wanted to give a little bit of that context around how we're seeing SA, and the important point here is we are calling out that at these levels of electricity availability from the grid, and I think those of you are following the news that we probably electricity availability factor in South Africa is at 58, so it's below 60, and the target is to be at about 75. We're saying that problem is not going to be resolved anytime soon, and we need to arrange ourselves across our network to be able to have the resilience, batteries and gensets and securities. We're not going to look exactly like the Nigeria network where every single site has a genset, but I think we certainly are not going to look like the site in the medium term. Our sites are not going to look like they did when they relied 100% on grid power availability. We don't think that's is realistic, and we are preparing ourselves for a much more a network configuration which is a mix on reliance on grid, but quite a lot of reliance of off-grid power, which we need to arrange ourselves with the support of our power, our passive our power providers, particularly IHS. If I talk about how we see navigating the context ahead, I think the programs we're going to implement are essentially the same that we had in the year prior. The same programs around commercial, supply chain, network and financial resilience. So all the work around CVM and price optimization. And price optimization has many elements to it. It's not all headline pricing, but I think you should anticipate that we're looking also at headline pricing around on the prepaid side in South Africa. We've effected a below inflation increase on postpaid, and we will have to also bring in the course of this year on the prepaid side as well. The continued work around managing the device margin will remain a feature. Obviously, we're not going to be selling devices at zero margin. There's always going to be a slight decrement to margin. But if we're getting the attachment to the network and the data growth, this makes an enormous amount of economic sense to provide some of those device margins. On the network, we're going to continue to focus on the work around the TowerCo agreement, the South Africa TowerCo PAS agreement. We're engaged with IHS to review that going forward, and in Nigeria, the 2024 portfolio is one that it's a subset of the total portfolio. That is one that is being progressed at the moment, and we'll continue to work on the accelerated power resilience plan that Charles and team are implementing. And then on financial resilience, and maybe it's something that we're harping on too much around, remaining flexible to take on further liability management opportunities as they come. 2024 is not far away. So we're taking the prudent approach that where we've got resources and capital to deploy, aligned to our capital allocation framework, we want to extinguish the Eurobonds, the 450 million of Eurobonds ahead of some of the other capital allocation priorities. As Tulu said, to flatten that Manhattan and give ourselves a lot more financial flexibility for both to absorb shock, but also to take advantage of opportunities as and when they come. So the headline here is, as we're looking ahead, same 4 programs, same sort of activities, and a lot of focus on making sure that as an organization, we execute on what we have said that we would do. The other points looking ahead is that we still think the Ambition 2025 strategy and the targets that we set are broadly intact. We set this strategy 2 years ago. We have a Capital Markets Day on the 1st of June, so hopefully you've received and sent back your RSVPs. But our focus in the year ahead is to stick to the program, to stick to the areas that we've set aside around building platforms, leading industry connectivity, creating shared value, and the acceleration of the portfolio transformation. We will give a very detailed, deep dive around all these programs at the Capital Markets Day, and hope that you'll be able to join us here at the 14th Avenue campus. But for the year ahead, this remains a priority in terms of, and we think that the investment case remains very compelling, very strong and leading connectivity business that gives us the infrastructure to be able to expand into other verticals, supported by a very exciting demographic opportunity. We were looking at our smartphone penetration numbers the other day. We've seen great progress, but actually, where are we? We're only 58% smartphone penetration within our base. So a lot of our customers have actually not still, had the benefit of, exploring the internet and the advantages that it brings. So we really do think that demographic position, as well as our own market positions, the financial profile that we're seeing improving over time, really, ensures that the case for capturing growth across our African markets is that MTN remains, in our view, best positioned to capture that growth, driven by, in particular, our discipline around capital allocation. And just on the investment case, we still think, and we'll cover a lot more of this in detail at the Capital Markets Day, is that we see, strong value pools that we can capture going forward. On the core connectivity side, voice remains still resilient. I mean, if I ask Jens, who's sitting in the audience here, what he thought voice would be at this time, he would say it would be X growth. We're still seeing voice at 4% growth, and that's South Africa, which is, growing voice negatively at just on 8%. So the rest of the markets, actually, voice is still a material driver of the top line and being accretive to margin. Data is what's powering the business today, and the future, we believe that the future will see a lot more traffic move towards the home, and we are arranging ourselves to be able to participate either through fiber or fixed wireless access, and owning the fiber, and in particular around the fiber core investments that we have been doing, I think, gives us a lot of space to continue to grow on the connectivity side. And then on the fintech side, obviously, on the platform side, continuing to make good progress on fintech, digital enterprise, network as a service, and the API marketplace, which we branded Chinosis here at MTN. Just on the capital allocation framework, as I mentioned earlier on, we will remain disciplined with this capital allocation framework guiding the decisions that we make. And the order you see it is actually the batting order that we prioritize. Every rand, every cedi, every naira of capital is decision-making that we make as a company is driven by this. So we're putting enough capital to this unique opportunity that we see. We're spending 37 billion in this coming year on current assumptions on exchange rates, because we see a significant opportunity that we can drive returns on. The faster deleveraging, we made enormous progress, as you saw from Tsulu's slide, but we have a focus to also look at the Euro bonds, the 2024s and 2026s. We still feel that we don't want to have that kind of currency mismatch within the context of the debt. So we are pushing towards deploying capital to liability management in that regard. So we're very focused for the opportunities, as and when they come. And then the returns to shareholders via cash dividends is then batting order number 3. Now, we have positioned the guidance to 2023 on the dividend at what some of you may conceive as conservative at 330 cents. Now, to give you a sense of framing, given those other capital allocation priorities 1 and 2, we framed this dividend policy as a minimum. So we're putting the 330 again as a minimum. You'll remember in 2020 we put 260 as a minimum, and we set out a very specific set of conditions where we believed that situations could arise where we actually pay more. We said the minimum is 260. We paid another 40 cents. We paid 300 cents, because the 3 things that we said, if these things are met, we would be happy to pay a higher dividend. And when those met, we were happy to pay a higher dividend. So what we're saying with the 330 cents for FY23, it's the minimum that we believe that under all the stress conditions that we've painted, we should be able to deliver to shareholders. If we end up paying more, what needs to be true? 2 things need to be true. One is we are seeing cash upstreaming from the markets, particularly Nigeria, coming through, particularly in the second half of the year. We've taken a cautious position in framing our balance sheet. So if there is the cash upstreaming that's coming through, and we make more progress on the asset realization program, which we anticipate we can see some progress in H2, you know, obviously that minimum would have to convince shareholders why we wouldn't pay more. And as I said, our history and our track record is when we see things change in that way, you know, we are disciplined enough to be able to say, well, actually, we set out the conditions under which we would end up paying more. So the conditions, you know, are really around those two elements. And we also want to impress that we have a very healthy liquidity position at the moment, 60 billion rand. So, you know, but we are saying that we want to focus on the other two priorities on our capital allocation framework. As long as we can meet those, and the Eurobonds is a particularly important one, you know, we would be willing, as the board would be willing to consider, you know, an increment above the 330 cents. So I wanted to put the framing of the 330 cents forward guidance within the context of our capital allocation framework. Balance sheet is in a very strong position. We have very strong positions around liquidity. Finally, I just wanted to again confirm our guidance. Notwithstanding the macro challenges that we see in the near term, over the next 3 to 5 years, we believe the investment case is compelling. We believe that the medium-term guidance remains intact, and we are recommitting and reconfirming our medium guidance on all the elements that we've had before. And we believe that we're positioned as MTN to be able to take advantage of the opportunities whilst we are, you know, working our way through some of the headwinds that we may see, particularly in H1. And we certainly believe that towards in H2, Q2, and Q3, we should see better, you know, performance coming out of the business. Ladies and gentlemen, thank you so much for listening to Tsulu and I for the last hour and a little bit. We had a lot to say because there's a lot that's going on. And we trust we've given you a better understanding of the results. I think we will take a couple of questions. I'm joined by other group executives here. So the very difficult questions I'll pass on to Charles, Jens, Yolanda, Lele, and others. But maybe I'll ask Tsulu to join me on stage, and then we'll, as well as Tato, to moderate the Q&A.
Thanks very much, Ralph and Tsulu. Quite comprehensive, as you said. I hope it was clear to everyone and useful in terms of the presentation. I think we can kick straight into Q&A, and maybe we start in the room. And we have Louise, who's got the mic. Go ahead.
Hello. So I'm Louise from Investec. I guess you know, to just highlight on South Africa, and I guess the load shedding elephant in the room. What is your views on the probability of a total blackout in South Africa, and how are you planning for this? And second, on South Africa, I appreciate you don't comment on churn rates, but during the various stages of load shedding, what are you seeing on specific you know, churn rates at the various levels? And then the third question is on the advisory board. The term has ended. Please, can you provide more thinking around changing this into a more stakeholder forum? Thank you.
Okay, can I ask my colleague Charles to come up? I think he's going to have a lot of questions, so you might as well stay up on stage. I mean, maybe I can start off, Louise. I think we don't think that stage 8 and a total grid collapse is highly probable. We think it's a very low probability event, but obviously you need to plan for that even low probability events. And I'll ask Charles to kind of give his kind of evolving thinking about what would happen in that kind of scenario and how we think about it. And then I'll ask him to comment on churn rates, and I'll come to the IAB.
Louise, I didn't see your face. Oh, there you go. I think on the issue of total grid failure, look, first of all, let me say that the network is in segments so that we get a perspective of where the failure could be. So the network is divided into multiple segments. We've got the core network, which is housed in this campus here, multiple hubs, multiple switches. That part of the network, you know, you can take it for granted that we'll be able to secure it. Why is that? Is because this is covered through proper gen sets, and we are putting a solar farm here. So I'm quite comfortable that, you know, in terms of the campus, which is the core part, the nerve center of the network, we should be okay. Where it gets a bit complicated is on the distributed nature of our sites. So that becomes a bit challenging because you have to actually deploy power across all multiple points, which is not really practical. But what we're doing is importing and bringing gensets. You want to maybe put about, let's say, argument's sake, I'll give you a number, give you a range, I say 3,000 to 4,000 gensets in that case. That protects, what you arguably is the critical sites. That is the plan. That plan is not done necessarily for the grid collapse. We're doing it under the perspective of load shedding as it is today. It should help. But I also think that, as we discuss with a group of CEOs, because this will be catastrophic for the entire, industry, we are talking to the ministry, we are talking to the Comcom to say, should this eventuality occur, is there a possibility where we can actually sub-segment our radio access network and roam on each other's network? Look, that has to pass proper governance and processes. But we are looking at the possibilities of how do we collaborate. We think it's unlikely, but we think that our preparation around load shedding helps us to a certain extent to be able to prepare for that. You also asked the issue around churn. I mean, look, we will be upfront that you can see the quarter performance that we have been very clear that we have battled when it comes to quarter 4 around load shedding. You do see some slight degradation around RGS1 numbers, which is the customers who are active on a daily basis. We are comfortable that as we go into half 2, because if you compare half 2 availability compared to where we are now, you will start to see an upside. So if you compare this January compared to last January, this was 78% almost availability compared to what we had before. So we are relatively comfortable that as we go into H2, we'll be able to recover. Thanks.
Yeah, so maybe just on the point that Charles raised around, the state of disaster, related to your question about total grid collapse. I mean, our point of view is that we should be using the state of disaster actually as a unique opportunity to try and create resilience across the networks. So, I mean, we're already sharing sites. Is there an opportunity to look at, how do we share, power in particular? Obviously, that needs an arrangement around the Competition Commission. Charles spoke to the roaming point of view. So I do think we need to lean in. I mean, a little interesting note is that, obviously we're working with IHS, and they're used to these kind of networks that are largely off-grid. So the electrical engineering skills you need to work in the sites is not available in South Africa, by the way. They're not largely available. So we've had to bring in people from Egypt, Nigeria, and other places. And the challenge we're getting is visas. So under this dispensation of a state of disaster, what we would be seeking additionally is some special dispensation around the visa regime to enable us to bring in the electrical engineering technicians who actually have the skill sets to manage sites that are kind of largely off-grid, and that's something that we continue to be talking to the authorities about. On the IAB, as we noted in the sense, the IAB's 3-year term, came to an end. And firstly, I'd just like to thank President Thabo Mbeki and other members of the IAB who have been fantastic in supporting us with their views on nation-state issues. The board resolved to take a view that we would evolve into a much more open architected stakeholder platform, kind of many fancy words. What that basically means is that we would draw upon as and when, from experts in any areas, nation states, technology, etc., as we actually have been doing with the board anyway. And the IAB would, members, if they're available, they would also be part of that. So there wouldn't be a board, so to speak. It is as and when there's a particular issue and we have to, and it wouldn't limit it just to the existing IAB members. We would be happy to call upon them, but there will be others that we would seek their views to inform and enrich our views around the macro, technology, and other broader matters that the board may apply themselves. But I did want to take the opportunity to thank President Mbeki and other members of the IAB for the sterling work and the support that they gave us over the years.
Thanks, Charles. Thanks, Ralph. We've got Precious got a question.
Hi, everyone. It's Prashandan from Nedbank. I've got 3 questions from my side. I believe that your SLA with IHS is 98.2% uptime on your network up to stage 4 load shedding. What happens now that stage 4 is the base case, and what is your agreed uptime on stage 6 and above? The second question is, you mentioned your fintech carve-out, but just wanted to get an update on your FiberCo carve-out. And now that you've got such a healthy balance sheet, will you relook at telecom, in particularly OpenServe? Because I think that's the crown jewel that you guys want. And then the last question is, you're still showing your Naira at the official rate of about 470 for the next year, but at what rate are you actually getting cash out of that OpCo towards the latter part of the year? Thanks.
Thanks, Bruce. Let me just start off by saying the 470 you saw is Bloomberg and IMF. It's not, it's not our rate. Go first.
You want to go first?
Okay, yeah, thanks.
On the SLA.
Sure. Presh, I think, look, you are right about the 98.2, but I want to take a step back. I mean, when the construct of the deal was done, if you look at the graph that Ralph showed, I mean, we started the deal, let's say, in 2021. No one really thought beyond, stage 4. I mean, we thought that stage 4 would be force measure. So what we're doing now is going back to the drawing board. We need to do further deep dive and discussions. I'm not able at this particular point to be able to give a definite position in terms of saying what happens at 6 and 8. I think we need to reflect a little bit. I mean, there's a point that Luisa made also about what happened to the great collapse. So our thinking now has evolved a little bit more compared to where we are. We'll just appeal for a little bit of time, explore the idea. The discussion, though, with IHS is on the table as we speak. So we'll get a position, let's say, probably in the next 2 maximum months to be able to get a perspective. Thanks, Presh.
Yeah, just on that point, Presh, to kind of fortress what Charles raised, is we are actually in discussions with IHS on that. We set the contract at force majeure at stage 4, where we start to share some of the additional power, which is what we've explained in how we're providing the margin guidance. But, they're open to the discussion. They also understand that, the environment is a lot more different than what they anticipated. I think the thing that gives me comfort is that these guys are very skilled. I mean, they run a network in Nigeria with 17,000 towers, with 5% assumption on grid availability. So 95% you're off the grid, and you need to maintain a 99.75 network availability, which they do in Nigeria, and they move 300 million of liters across the country with 30,000 people. So they understand the logistics, and these are our partners, and we feel that we'll find the right answer. As we now take a view that actually stage 4 plus actually is in the near term what we anticipate we'll see across our networks, and I guess pretty much you'll see across the other networks. On the process with fiber, maybe I should ask Jens he's in the room, we're sharing the speaking here. Jens is responsible for all our global connect activities, so he can add to the chorus of executives that you see up on stage.
Yeah, thanks for the question. On fiber, maybe worthwhile to distinguish between 2 different parts of the business. So on the global connect side, we are focusing basically on metro fiber and above, so that's metro, backhaul, and undersea cable. And we expect to complete the carve-out of that business materially by the end of the year. That will give us optionality in a similar way as in the fintech business to look at minority participations to bolster basically the opportunity to invest further into that side of the business. But we are also planning in the meantime to accelerate our existing rollout of fiber. I think in the results we communicated that we invested well over 5,000 additional kilometers of fiber built last year. We have similar plans for the next few years, and we are open to an acceleration as we believe that there is significant backhaul capacity demand building over the future. The other part of the fiber business is more related to fiber to the home. And here again, we have a special situation in South Africa where the market is already quite developed. I think there was a hint made to our interest in telecom. I'll leave that for Ralph to comment on. But we obviously were interested in telecom for a number of different reasons last year, including their fiber asset. We do agree that potentially achieving a relevant position in FTTH in South Africa will not be possible without acquisitions. I think that's very clear in our strategy. That said, in other parts of the footprint, particularly in West Africa, in markets like Ghana, Nigeria, Cote d'Ivoire, we see significant opportunity to get an early start in FTTH build. And we've recently conducted some research internationally in other emerging markets, Latin America, Southeast Asia. There is a potential to build at relatively low cost if you have permission to build aerial fiber rollout. And we do think that there is a business case ultimately to go after a significant chunk of middle class, lower middle class to upper class homes in these markets that will eventually pivot to fiber demand as well. And we keep a watching brief on how much we can do in these markets as well. But for the avoidance of doubt, that is not related to the Global Connect asset. That would be a separate investment, more likely led through the operating companies in a capital structure that we would still need to find the right approach to. Thank you.
Yeah, you'll hear Jens talk more about this, the Capital Markets Day. Jens has just come from what I'll call a global tour of seeing what's happening in other regimes where we think there may be alternatives around the home. Pressure on your questions around OpenServe being the crown jewel. I mean, we've got no discussions with Telkom as we speak right now. And I think it's presumptuous for you to say it's the crown jewel. We think we thought it a little bit more differently than just the crown jewel point that you raised. In terms of the Naira, to the point that Tato spoke about, that's a Bloomberg estimate. I mean, of the cash streaming that we've done, the limited cash streaming that we've seen in the year, the number is 550, 560 is the number. Pretty much the same as we were getting at the back end of last year. I'm just checking my questions. Have I answered all your questions? Yeah.
You did. Thanks, Ralph. I've got a question towards the middle.
Thank you. My name is Tkele from ABSA, and my questions are clearly on theme, so largely focusing on load shedding and the fintech business. So with respect to load shedding, I think there's been a lot of focus in terms of stage 4 scenario planning and the likes, and obviously the backup solutions relating to that scenario planning. So I think obviously as we go into the more intense stages, then the repercussions continue. So greater recharge time, greater expense in terms of diesel for generators. So what I didn't necessarily hear much of is a focus in terms of renewable sources of energy. So maybe I know Charles had mentioned something about a solar farm. So if I could please have more detail in terms of the innovations around that, please. And then secondly, in terms of the fintech space, so of course I think I see that I note obviously that the fintech growth and focus is largely in terms of the other parts of Africa outside of South Africa, and less so in South Africa. Obviously assuming that's got to do with demographics and cash-based societies, but I'd like your view in terms of what's really driving that, and just a sense of the timing around the standalone carve-out of the fintech business. Thank you.
You want to touch on renewables?
Yeah, I'll happily do that. Stella, I think the point, first of all, let me explain that the network in South Africa was built with a default expectation of grid availability. That dictated the level of the volume of real estate that you design around the site. That's very, very important. So it is not an easy build to place panels because you essentially don't have enough real estate. Yeah. But what we are doing, we are starting right here in 14th Avenue. We have a project that's starting in a month's time. We will be able to deliver 40% of this campus through renewables. That's number one. The second thing is that we are running this thing in 3 phases. There's adjacent land on this site. We'll be able to deploy another energy farm to be able to help us to do that. Thirdly, we also had a discussion with the SA board about what can we do around IPPs. I won't go too far on it, but we have exploratory discussions around what can we do around IPPs. I also have to mention that getting IPPs does not mean that we'll be able to wheel the energy directly into our sites or into our energy farms. But what it will do, it will help us to offset the credits that we'll be able to battle with. So that's on that. However, on the number of sites that you have, we've got about 12,900 sites. we are looking at this on a site-by-site basis. On sites which are safe, here I'm talking about rooftops, malls, clinics, in all of those areas, estates. We are talking to all those landlords who say we should and we must actually deploy solar farms on there. The other ones which are prone to theft, it is very, very difficult for us to commit that we're going to spend money and only to lose the panels the following day. So it's a mix, it's targeted, and it's pragmatic. Thanks.
Yeah, just on that point around security arrangements, actually, Charles has 3 categories of security. We're going to have to put some of our backup batteries actually in bunkers to prevent them from being stolen. The level of vandalism across our sites, and I guess more nationally, is that there is actually a secondary market for these batteries. So there's quite an investment around the work that we've had to do to secure the batteries. And some of them will have to be actually in bunkers, but actually, to Charles's point, at a different security level, actually you can have solar panels, but you need to be aware that, or you need to take a view that the theft risk with regards to those panels will actually be low. Just to your questions on fintech, and there were 2. I mean, one is really around South Africa. I mean, South Africa's regulatory regimes are such that fintech needs bank sponsorship, and we are under the kind of bank sponsorship today through African Bank. The regulatory landscape in South Africa, I guess, is changing, and I think there were some pronouncements made by the SARB last week, that are very encouraging, that it's going to get opened up to non-bank players. So for us, South Africa will always be a little bit different because of the maturity and the availability of financial services. What we're focusing on South Africa is better than cash. We're not trying to compete with the retail banks. We're actually trying to be a complementary to the work that the banks are doing, to mobilize deposits and all of that. But for us, watching how the regulatory landscape changes in South Africa, which is encouraging, will be important. On the fintech carve-out, as we've reported, we've gone across all the 16 markets, created various separate companies from the GSM, implemented intercompany agreements that regularize the flow of services and what it costs. And to Tsulu's point, that's what she mentioned, that actually the margin evolution is in progress because we're now actually having fintech on a fully costed basis. The margins, you'll remember, are like mid-40s. When we're talking about mid-30s, there's another 10 percentage points of margin that goes to create a normalization of the cost. But it's a business that's going to have very high free cash flow, mid-30s EBITDA, and approximate levels of capex intensity in order of magnitude 2%. So you still see healthy 33% free cash flow outcomes from a business that actually is very scale and large already. We're well progressed, with the initiatives to create that separation. And to Jens's point, linking back to where the focus is, the focus has been on the fintech. But as we go towards the end of the year, we're focusing more around in the progress we make around fiber. I know you want to take some questions online.
Yeah, let me just throw 2 questions in from the webcast. The first one, financial one, given the progress on the expense efficiency program, how much is left of that, and what do you see as the prospects for further savings given the inflationary environment? That's the first one. And then the second one, sort of related to that, around towers. Given that there's no diesel pass-through for the Nigerian towers, are you able to replicate that in your other tower agreements like Ghana and South Africa? And then maybe just the last one linked to that, almost the opposite way around. Are you able to negotiate IHS tower contracts from USD-based pricing to local currency?
With the expense efficiency program, I mean, as I indicated, we had an expense efficiency program that started in 2020. We've been able to deliver the results on that one. It is an ongoing effort. We are actually looking at expense efficiency 2.0. We do think that there's opportunities in digital transformation, in renegotiate when we go into new contracts with our vendors, negotiation of unit price reduction, and it's something that we have been doing, process automation and the likes. So we are looking at that. For our 2023, we have a target that we have put in place, but essentially we see expense efficiency saving as an ongoing effort given the challenging macro environment. Yeah.
Just on the tower side, I mean, I'll try and keep this, fairly summarized. Diesel pass-through in of itself is not a problem because it's only part of the overall tower contract. I mean, there's use fees and all other elements of it. So I don't think one should focus so excessively on the fact that you do get diesel pass-through. There are other elements of tower agreements that can bring on costs. But obviously on the Nigeria side, the existing arrangements on the majority of the towers are actually under IHS. There's a small portion under ATC there, but the majority of them are, there isn't kind of diesel pass-through. It's the nature of how these contracts were negotiated, and there's two cohorts of them in Nigeria. One's where the tower, the contracts end 2024, others, the majority 2029. The 2024 portfolio is the one that's is been under discussion and under review, and when we conclude that, I'm sure we will be updating you in the markets. In terms of local currency pricing, we do favor a profile where we have as much of local currency pricing in the towerco agreements. There's always a level of dollar indexation because if they're bringing diesel in, you have to be also alive to the fact that there are some dollar components. So if there are dollar components, the towerco contracts that relate to directly a dollar, there's a lot of work that's around civils. That's all can be, very much priced in local currency, but there will always be some component. And it's not only about the dollar indexation, it's about the CPI escalations as well. So it is quite a complicated arrangements of different price components that you need to look in the rounds to say, does this look similar to if we were running the network, the passive infrastructure ourselves. So, we talk about should be costing, which is, the effective rate of all those components working together. And if it's below should be costing, for sure, the towerco company, which is very skilled at this, should be the one that is actually managing these contracts, even if you're exposed to some sort of market risk over a 10-year period. And in terms of negotiations, we have negotiated several of the agreements, and as the one that I mentioned, the two important ones are the 2024 portfolio IHS in Nigeria, and Charles is looking at the power as a service in South Africa.
Thanks, Ralph. I think we need to wrap up, but before I ask you there's one more question, last question, and then we can wrap up.
Good afternoon. Thanks, Ralph. Thanks, Charles. Thanks, Tato. Thanks for the great presentation. The name is Clement from EcoBank. You've spoken at great lengths in terms of some of your bigger markets, such as Cote d'Ivoire, Ghana, Nigeria. And obviously, you've spoken a lot about South Africa, particularly with regards to load shedding and the preparations for stage 4 and north of. For those of us who come from the African continent north of the Limpopo, we consider it past, so we're pretty used to it. If I may, just in terms of your other smaller markets, such as, and I'll use two that are top of mind, Equatorial Guinea, Guinea-Bissau. What is the group's view in terms of how you're going to support them? Because those are markets where your competitors have taken a direct decision to undercut you in terms of pricing. Will group continue to support them technologically, operationally, financially? And if the answer is yes, how? Thank you.
Yeah, thank you for reminding us that north of the Limpopo, power is, is also kind of intermittent, or on-grid power is intermittent. And specifically to your questions about the small markets, I mean, we have a portfolio view on MTN. We operate in 19 markets, and we want the markets to be able to finance their own growth. Obviously, group provides an enormous amount of resource and capability to support it, to be able to underwrite, write letters of comforts to banks like yourselves from time to time to enable those operations to be able to fund their own growth. And as long as they're meeting that acid test of funding your own growth and with some group support, I mean the portfolio absolutely works. Yes, we do know that there are markets that from time to time are challenging. I mean, if I look back, let's say Liberia, 5 years ago, we looked at Liberia and said, Liberia can't turn around. I mean, actually, Liberia has turned around and actually has been generating profits and actually have sent us, paid back some of the group funding it was given. So there is a capacity for some of these operations that are in very challenged circumstances to turn themselves around. So we will remain disciplined around the framework we look at markets that need to tick the box of being self-sustainable. And we've seen enough evidence that at times these opcos can actually turn around their fortunes over time. Would we want better performance out of Guinea-Bissau? For sure. Would we want better performance out of Guinea-Conakry? For sure. Would we want better performance out of Nigeria? For sure as well. So, we never absolutely satisfied, but I think that should give you a sense of how we think about the framework, which is basically, a market must fund its own growth. Tulu is unlikely to be writing checks into the markets, from a point of view of, creating, sustaining, if the situation is unsustainable.
Thanks, Ralph. I'm going to ask you for some closing remarks, but before I do that, let me just invite everyone in the room. There's some cocktails and snacks outside. Some of the management and executives will be there, so you can ask some of your questions. Hopefully they don't reveal anything they shouldn't. But with that, just some closing remarks from you, Ralph.
Yeah, again, thank you all for spending the time with us today. We spend a lot of time talking about the past, but obviously we need to look into the future. And a few things that I just wanted to reinforce. Firstly, we're very pleased with the performance last year. We were able to weather quite a lot of the inflationary pressures that we saw during the year, and deliver really good performance under a challenging macro. As we look ahead, we anticipate H1 to be very fairly tough across some of the markets. South Africa, as I mentioned, we do look for a relatively weaker print on service revenue and EBITDA in H1, but actually improving into the second half of the year as our network resilience plan takes hold. You heard Charles is very committed in driving that. So we think that the financial framework for South Africa remains intact, and we're going through these changes of accepting now that stage 4 plus actually is the base case. It's no longer a situation, and as I said in other comments, that we really do call upon both governments and business to seize this moment where South Africa finds itself to really drive financial resilience around critical national infrastructure. But the South African business will deliver good cash. That cash supports some of the funding and other capital activities that we have a group, and hence we felt the confidence on the 330 cents that I raised. The second point is that we're very well arranged as MTN to be able to capture the growth opportunities we see in our markets. We're number 1 and number 2 pretty much in every market. We have scale, so that our scale enables us to take on shocks, but also to take on advantages of opportunities which are going to come in the period that lies ahead. So the company is very well placed to continue to grow and scale. And the final point is that financially we're in probably the best shape that we've been in a very long time. Certainly over the last 6 years I've been at MTN, to see the balance sheet in such great shape. Many thanks to Tulu and the team and the broader MTNers at that. And the level of liquidity enables us to withstand shock or take advantage of opportunities. Opportunities are going to come in this period, and we need to be ready to take. We thank all our investors and shareholders. Hope you enjoy your 330 cents dividend that we've declared for 2022. And we remain guided by our capital allocation framework as we think about the period ahead. Thank you very much. And for those who are in our premises, please join us for some refreshments after this presentation. Thank you.